Hi guys, welcome back to my channel. In today's video, I'm going to go through my swing trading strategies with you guys. So I'm going to go through exactly what I look for when I am swing trading, what expiration dates I look for, what patterns I look for, what strategies I implement, as well as what strike prices to select, how you want to look at volume, and so on and so forth. There's a lot of things that go into swing trading, and I know I post a lot about scalping and mostly day trading, but I do like to implement some swing trading as well. Obviously, it's not my go-to strategy, but there are a ton of opportunities in the market if you like to swing trade. And if you're someone where your schedule doesn't allow you to day trade or scalp as much because you don't have the time, swing trading is a great alternative to getting started within the market as well, because you don't have to watch your positions as often, as long as the stock is holding your stop losses and it is hitting those profit targets. You just continue to stay in the swing trade until you get an alert that you need to exit. That being said, there are a few things you want to pay attention to when you are swing trading, so we're going to go through some of those first. So the first thing that I just touched on was selecting strike prices. So when you are swing trading, you want to select a strike price that is out of the money but not too far out of the money. So you want to select a strike price with high open interest and volume, and then you want to select a strike price with your profit target in mind. Let's say you were looking to take a swing on Tesla, for example, and you want to enter calls at 210 and your final profit target is 260. So from 210 to 260, you have levels at 235 and 250. So if you were to select a strike price, you want to pay attention to what your final profit target is and then what your levels are in between your entry point and your final profit target. That being said, as an options trader, your goal is to get your contract as far in the money as you can within the time frame that you're in that position for. So within the expiration date, from where you entered and your expiration date, from where the entry point is to your profit target, you want to make sure that you're selecting a strike price that has the ability to go into the money, as far into the money as possible. The further in the money that strike price goes, the more profitable you are on that position, okay? So I see a lot of people that want to swing trade and buy expirations that are way far out of the money. That is going to be, the stock is going to have a harder time getting into the money if the strike price, let's say your entry point is 210 and your final profit target is 260 and you're buying a strike price at 300. That doesn't really make a lot of sense. So it should make sense from where your entry point is to where your final profit target is. I would select a strike price that is in between the two. If it is a large swing trade, if it's a further out swing position, you want to select, for example, from 210 to 260. I would either select a 235 or 250 strike, and whichever one of those strike prices has the higher open interest and volume, that is the play that you want to take. That is a strike that you want to take. Next thing you want to pay attention to is your expiration date when you are swing trading. So you always want to buy at least 2 weeks out, no matter what position you're taking. So I see a lot of people that will swing trade weeklies, and that is extremely high risk. Okay, just like trading 0 DTE as a scalper or day trader is high risk, swinging weeklies is high risk as well. And if anything, swinging weeklies is even higher risk because you give yourself a bigger stop loss, okay? And sometimes that can have you in a bigger deficit when you're in a swing trade. You can be down 30-40% of your position at a time on a swing trade. So you always want to make sure that you are giving yourself time. The best thing and the most important part of being a good swing trader is allowing yourself time, okay? Buying yourself time. The more time you buy yourself, the more easy it is to take a swing trade, okay? When it gets within that 2-week period, what you'll notice is that theta starts to kick in. Okay, theta starts to kick in on your contract within that 2-week period. That's why you always want to buy at least 2 weeks out, even if it's an overnight swing. Okay, anything else, obviously, you want to buy way farther out. But if it's an overnight swing, you always still want to buy even a 2-day swing or a 3-day swing. That's what you're anticipating. You still want to buy at least 2 weeks out so that theta decay, if the stock does pull back, isn't affecting your premium as much. If the stock pulls back and you're trading weeklies and you're swing trading, let's say you get in on Monday, by Wednesday, the theta decay has already kicked in and you have already lost a lot of profit on your premium, okay? You've already lost a lot of value to that contract because of theta. Theta is working against you. So the best thing you can do as swing traders, because theta is usually closer to 0 on longer term expirations, so further out expirations outside of that 2-week range, you won't see theta decay as much. So within that 2-week range, you see a lot of theta decay. So make sure that you understand that and you buy yourself time no matter the length of the swing that you're looking to take. Next thing you want to pay attention to is your entry points and exit points, especially your entry points. Your entry points are going to be really, really important when you are taking swing trades. You always want to buy on pullback, so you don't want to purchase a swing trade as the stock is making the move up. You want to wait till the stock pulls back. You want to wait till the stock is holding a level before you enter a position. Don't just enter a position as the stock is making the move up or down. You also want to wait closer to the end of the day. Now, whenever I look to enter a swing position, I always wait until the last hour of market open to determine if that is the day I'm going to enter that swing. The reason behind that is, for the most part, when you are looking to enter a swing position, you are going to enter that swing on a higher time frame. You are looking at that swing position on a higher time frame. So the daily time frame, the weekly time frame. So you want to see where that stock closes on that day. Okay, you want to see where that stock closes on that week, on the hourly time frame, on the 4-hour time frame. Okay, you're not able to see that if you're looking at the stock on the 2-minute or 5-minute time frame in that same exact day. Okay, so you want to wait to see how it's performed in that day, because what can happen is, let's say you're looking to swing calls on a position. Overall, on the 3-year, weekly, and yearly time frame, you see that the stock is on an uptrend. It's holding the uptrend. But let's say for that day that you were watching it, for that day that you were looking to enter that swing, the stock was on a downtrend. Now, if you had entered that swing right at open, what would have happened is you would have lost a lot on that premium, and you would have had to make that back up. Whereas if you would have waited closer to the end of the day to see where the stock is closing, that gives you a more optimal entry point. Even if it was selling all day and you finally see that it's sold to your support and your level of where you can enter your swing trade, you can then enter that position on a bounce. That'll give you a better premium price on entry versus you buying at open and the stock sells the entire day. And then what most people end up doing is either they cut their swing because it hits their stop loss, or they will add more to their position, which is high risk. Okay, so you always want to wait until the last hour of market open, see where that 4-hour candle closes, see where that hourly candle closes, see where that daily candle looks like it's going to close, and then you enter that position. Next thing you want to pay attention to is patterns, support and resistance levels, obviously, EMA crosses, volume. You want to look at patterns on the higher time frames, whether you're looking at double tops, double bottoms, squeezes, triangle patterns. If you're looking for a trend line break or a trend line bounce, those are all strategies that you can implement while swing trading. So it's still implementing the same exact strategies as a scalper or a day trader. You're just looking at higher time frames. You're looking at different expirations. You're looking at further out strike prices. So those are the main differences here. But overall, when you're looking at a swing position, the strategies are the same, whether it's a gap fill, wick fill, whether it's a trend line break, whether it's a pattern break, whatever the case may be, those strategies are going to apply on any time frame that you watch it. I set implied volatility here below 30%. Now this will depend from stock to stock. Higher volatility stocks are going to have higher IV, and then lower volatility stocks are going to have lower IV. The reason why I put implied volatility here is because if it is a week where there's earnings, stocks tend to have inflated IV. So you want to pay attention to that. When you are swinging through earnings season, just be aware of where your stock's IV is sitting. Higher IV is going to be higher risk on that trade, because if the IV starts to come down, your premium price is going to come down, okay? Because the premium is already inflated due to the inflated IV. So you always want to make sure that you look at what is a normal IV for the stock that you're trading, okay? And if it is a normal IV, that's great. You can enter the swing position. If you see that it's higher than normal, why? Why is it higher than normal? You want to pay attention to that as well. And then the time frames that you want to look at are the 1-year daily, 3-year weekly, 4-hour. And then for entries, I will look at the 5-day and 15-minute time frame. Sometimes if I'm looking for maybe a 2 or 3-day swing or an overnight swing, I'll look at the 5-day, 15-minute. But overall, on the higher time frames is where you're going to capture those bigger swing positions on the stocks that you're trading. Another thing that I didn't put on this slide here that I want to mention is you want to look for news, okay? You want to be very, very aware as a swing trader what's going on in the market, what's going on in the sector that you're trying to trade, in the stock that you're trying to trade. If they have an event, if they have news, whatever the case may be, you need to be paying attention to what is the news that's coming out. Whether it's in that week, whether it's the next month, whether it's 2 months out, you need to pay attention to that news. A lot of people will enter a swing position. They won't look at the news that's either surrounding the stock, the company, or the overall market. For example, FOMC. FOMC can, no matter what your stock looks like on a technical chart, that looks like on your chart, all the setup, let's say the entire setup says that it's going to make a move up. If the Fed comes in and says that they're going to raise interest rates, everything's going to sell down. Okay, depending on how investors react to that news, it could potentially sell. So you don't want to enter a position on a swing trade if it's in the middle of news, okay? Or if you see news coming up, you want to make sure that you're taking profit on those swing trades. You don't want to hold it through news. Unless you have way far out expiration, you have time on the position, that's okay. You can still hold through news. But be aware that the news can affect your swing trade. Okay, so a lot of people don't pay attention to that when it comes to swing trades. They just base it off of the technicals that they see, the price action that they see on the stock. And when it comes to swing trade, because you're in the position for a longer period of time, you're more at risk to adverse events. So it's extremely important that you pay attention to what's going on in the market and what news can potentially come out. Let's go through an example of how I actually implement this. So this is Tesla's chart, okay? So the first thing that I want to do is, like I said, I always go to the 3-year weekly time frame and I work my way down, okay? So starting from the 3-year weekly time frame, I'll see if I see any specific patterns, if I see any trend lines or anything like that, I will implement that. Now I'm going to remove these actually. All right, so this is Tesla's chart here. We're going to go through an example of how I would potentially apply swing trading strategies and what I look out for when I'm looking for a potential swing trade. So the first time frame that I always go on is the 3-year weekly, and then I work my way down. If I don't see anything on the 3-year weekly time frame, then I'll work my way down to the daily time frame and the 4-hour. And if I still don't see any swing trading opportunities, then I'll just let the stock be. But if I see a swing trading opportunity on the 3-year weekly, I'll confirm that on the daily and 4-hour time frame as well. So just looking at Tesla right now, all I have on Tesla is the 30 and 200 EMA. I don't have anything else on it. So just looking at Tesla on the 3-year weekly time frame, I see a couple of things here. So the first thing I see is that Tesla is in an uptrend overall. Overall, it's in an uptrend. So you can see this is swing low. It started an uptrend here. This is the swing low here on the uptrend. This is one touch, and now it looks like it could potentially touch again, okay? So we have a little bit of a trend going on Tesla. The next thing that I notice is that Tesla is in a double top, okay? So that is a bearish pattern, okay? So double top is a bearish pattern. So Tesla is in a double top here, so I'm going to chart that double top. So the top looks like it's sitting from around 260 to, it looks like it wicked to around 270, okay? 271. So I'm going to zoom in for you guys. Okay, so this is the double top. The reason why I charted 260 and 270 is because it did wick above 260 and it wicked all the way to around 271. So I just want to chart this range. Okay, so that is the first target would be 260 if you were to take a trade here. Now, as it's coming down from the double top, you find the neckline. So where's the base of support for that double top? Now, if we come down here, look, this looks like it was the base of support here on the double top. So we chart that as well. This is sitting at around 180, okay? So that is the base of support on the double top. And we also have a trend line. So how do we play this? Now, in between the neckline and the double top, the resistance here, we have some levels of resistance as well. So if, for example, it comes down to 180 and bounces, where could it potentially reject? So we have a little level here at 200 where its 200 EMA is actually sitting. Okay, the yellow line is a 200 EMA. 200 is a level of resistance. Above 200 on Tesla, it looks like we have a level at around 210. Above 210, it looks like the next level up we have is around 235 on Tesla with these two wicks. And then above 235, it looks like we have another level here sitting at around 250. Okay, with the top of this candle, base of this candle, and candle here. Okay, so from the neckline at 180 to the top of that double top to at 260, we have levels at 200, 210, 235, 250. Okay, so there's multiple different plays within this, just this specific. So within this chart on Tesla, there's multiple different setups that can potentially happen. Okay, so the first thing you want to look for, let's say we're going to take the double top play. Okay, so what you want to look for here is as Tesla comes down here, the base of support on that double top is going to be 180. Okay, so if it breaks the neckline below 180, you can enter for puts. Okay, you can enter for puts with targets, it looks like around 170, and then below 170, Tesla can sell down all the way to around 140. Okay, so that's the initial setup here. Below 180, Tesla can sell down to around 140. Okay. So that's a double top break, and you can take a swing trade here. Now the other setups that you can take, and I'll go through examples of the strike prices and stuff in a second, is the bounce of this support, okay? So if we're still working on the double top, now remember the double top will only clear if it clears the neckline. So if it clears 180, then it's a true double top. What can happen is if the Tesla comes down, it can bounce off of that 180 support, okay? If it bounces off of the 180 support, you can buy calls on Tesla for a swing, okay? So you wait for one candle to hold 180, and then the next candle to open above that previous candle. This is your entry candle here for calls on Tesla for the bounce, all right? Let's say you're looking to buy the 180 calls on Tesla back up to around 260, where that double top was, okay? That's your final profit target. You think it's gonna hit 260. In between 180 and 260, what are your levels of resistance that you need to look out for? We have a level at 200, 210, 235, and 250. Now these are your profit targets as well. These are going to be levels of resistance that the stock could potentially reject at as you take that bounce play. So if you have an entry point of 180 and your final target, let's say, is 260, you want to identify how the stock usually moves. So in what increments does Tesla move if it is a trending day? Usually around 10 to 15 points Tesla can move, sometimes 20 points. All right? So if this is almost a 100-point play and Tesla on a trending day moves around 15 points, you're going to have to buy at least 2 to 3 months out on this play. Okay? That gives Tesla enough time to be able to even hit the 200, 210, and 235, your initial profit targets to the upside. That being said, on this play, if we're just looking at October 11th, just for today, which obviously hasn't gone through yet, but if let's say today was the day that it bounced off of 180 and I'm looking for entry, I'm going to, let's go ahead and look at our options chain on Tesla. Okay, so I'm going to look at, these are the expirations on Tesla. I'm going to look at the December 20th or November 29th. It's October, so I would probably look at the December 20th expiration. Scroll down until you're out of the money calls. And then obviously these are way out of the money, but that's because it hasn't hit the profit target. Let's say the 180 is at the money. Okay, so you want to look at from 180 to 260, where do you see significant open interest at your profit target? So we had a 200, 210, 235, and 250. So 200, you can see lots of open interest and volume on that 200 strike. Okay, 210, again, lots of open interest and volume. And then 235, if we scroll down here, not so much open interest on that 235. And then your 250. Lots of open interest and volume. Now, like I said in the beginning, your goal is to get your contract as far in the money as possible. If I were to take this position on Tesla at the 180 bounce, I would either purchase the 200 or 210 strike. Okay, that gives me enough time for the stock to get in the money. There's a lot of open interest and volume on those strike prices, which means that there are buyers holding those contracts. There are people holding those contracts at this expiration date, December 20th. So people are anticipating Tesla to potentially hit those profit targets. 200 is a psychological level and 210 is a level of resistance. So more than likely I would have purchased the 210 strike on this play, or I would purchase the 210 strike on this play once it does, if it does play out. Okay, 210 December 20th expiration. Okay, that still gives you about 50 points until your final profit target, and for it to go way far in the money if you hold some of your contracts. Obviously, as it hits each resistance level, you want to scale out, but overall that final profit target, if you buy the 210 or even 235, but the 210 gives you a bigger opportunity for your strike price for your contract to go as far in the money, so that you're making a one-to-one premium flip on this position. That being said, let's go back to the chart. So that's the double top breakout, okay? Now there's two other setups within this as well. Let's say that the stock breaks, you're looking for the trend line break here. So the trend line right now is sitting at around 210 to around 200. Now the 200 EMA is sitting at that 200 level. So that's actually the level that I would look for entry on the trend line break. If it breaks the trend line down, I would wait for the 200 break. The target would be 180. Now on a position like this, okay? From 200 to 180, you can purchase the 180 strike price on this if we go ahead and look. So this is about a 20-point move down. It might even happen in a week. So Tesla, like I said, moves in about 10 to 15 point increments if it's a strong trending day. So I would probably buy a couple weeks out, maybe a month out, so November 15th expiration. And I would look at multiple different expirations and see at which expiration date those premiums have the highest open interest and volume, because depending on the expiration date, you can see different levels of open interest and volume, and that can tell you exactly what levels and what time investors expect that stock to hit those levels. So it's really, really good to pay attention to open interest and volume. So just looking at the put side here on Tesla, obviously right now it's a little bit off because 180 is so far away and 200 is as well. So let's say you were going to take the 200 break on Tesla, and right now you're not going to see anything, but you would just look at, I would probably buy the 180 strike price on Tesla. Right now there's no open interest in volume because no one's buying it right now, but the 180 strike on Tesla would be a good opportunity here. And if you don't see a lot of open interest in volume, you would want to look at another strike. So let's look at November 8th and see. We're not going to see a lot anyways because it's too far out, but most likely I would buy the November 15th expiration 180 strike on the trend line break. So that would be the trend line and EMA break at 200 down to 180. Okay. Now, the third play on this is if it holds this trend line. Okay, so if it comes down, it holds 210 to 200, that range, and it bounces off of the trend line again with a trend line break. Excuse me, with a trend line break or even a breakout or bounce, you always want to wait for one candle to hold above or below the level. So you want one candle to hold above the trend line for a bounce here, and your entry would be the bounce of the trend line into the top of that range at 260 with levels at 235 and 250. Now, depending on which strike between 235 and 250 have the highest open interest and volume is the strike that I would select. This is about a 50-point move. I would buy early December expiration on this. Okay. So the goal as a swing trader is to buy yourself time. So early December expiration for the bounce up into 260. Okay. So just within this one setup on Tesla on the 3-year weekly time frame, we have multiple different positions. You can potentially take multiple different swings depending on how Tesla ends up moving, and you just wait and you're patient until the stock gives you the move and you look for entry. But there are multiple plays on both sides, both to the downside and to the upside. Depending if you're a long-term swing trader, you wait for the 180 break. If you want a little bit of a shorter trade, you wait for the trend line break at 200 or wait for the bounce of the trend line back up to 260. All the things that I look for when I'm looking for a swing position. So hopefully this was helpful. Like I said, on top of all of this, all of the technicals that you look at, you also want to look at news, earnings, any sector rotation, any sector news. Any earnings within that sector can affect your stock as well. So you want to always pay attention to all of those things, as well as FOMC, economic data that can potentially affect the market, can affect these stocks as well. All right, guys, so that's it for today's video. Thank you so much for watching. If you have any questions, go ahead and comment them down below. If you have any videos that you'd like to see next, also comment that down below. And I will see you guys in the next video. Bye.